Scott Bessent, the US Treasury Secretary, last week mentioned that, in his opinion, the US economy could outgrow its debt. Well, can it? And what effect would that have on US stocks? My name is Mark Williams. Joining me is Francois Savary, CIO of Genville Wealth Management and Consulting SA. Francois, hello.
Hello, Mark.
Nice to see you again. Thank you for joining us. He does have a point, Scott Bessent, doesn't he? Because either the US can turbocharge its economy and increase tax receipts and therefore reduce the deficit that way, or it can reduce spending, increase taxes, or it can tax all US imports with tariffs of 10%, like it's doing, or a combination of two of those things.
Yes, but the problem is that the tariff is not going to be sufficient, with what is happening in the US and decision last week of the lower house of the Congress to vote for the tax cut. And it means that what was decided in 2017, it was supposed to be over by the end of the year. It's going to be prolonged. And we all know that with this decision and some other tax cuts that were introduced, the US is going to grow its budget deficit by minimum 3.3 trillion US dollar over the next 10 years. So the administration is not going to go for higher taxes. That's not the philosophy of this administration. The tariffs are not going to be sufficient to cover this lack of revenues. And the big issue that they face is that reducing spending is, why do you do that? You are going to have a huge amount of money going to pay for the interest on the debt. You will have a lot of money going to pay for the spending in military, and you have Medicare and Medicaid. This is this area that they are currently targeting, which is Medicare and Medicaid, and it means that many Americans are going to suffer in this case.
In which case, you're agreeing with Scott Bessent. Their only way out, according to their philosophy, is to grow their way out of the problem.
Yes, it means that you need to be able to have an increase in growth, because this is what is essential. If they really want to be able, you need to act on the spending side, and you need to make sure that economic activity is going to be strong in the US for the coming years, because then with more growth, you have more tax receipts, and this is supposed to bring you to equilibrium. This is the famous theory of Laffer. At the end of the day, Mr. Laffer is the one who promoted at the time of Ronald Reagan the supply side economics, saying that there is an optimal tax rate that is going to allow you to make sure that at the end of the day, because you lower the tax rate, you increase the receipts. The problem is that this theory has not really worked very well in the course of the last 40 years.
So what does this mean for US stocks, especially growth stocks, everything that's really been driving the US economy, the US stock market, for the last 2.5 years? It seems that even Elon Musk is supportive of putting a rocket under the US economy. I couldn't resist that one.
Yeah, at the end of the day, all the people who are around Donald Trump and his administration, and all those people coming from the AI and all those areas, the growth part of the stock market, all those people are in favor of what is happening in terms of the decision that the Congress is going to make in terms of reducing taxes, because this is very favorable for their business. This is very positive for them. So that's a support. I still think that, when you look at the program of the American administration coming into January, you had two sides. You had the tariff side, protect America. It was to recreate a manufacturing base in the US. That was, in a way, the negative part of their plan, because this means that you are creating perturbation in the international trade business, which is never very, very good, because we all know that in order to be able to grow, you need to have trade. That was the negative part that was introduced in the first 100 days of Trump. Now he's going for the second part, which is supposed to be very positive for the fast-growing business in the US, which is continuing with the tax cut.
If you or anyone believes that they will do that, they will push ahead with that kind of policy, that means we have to buy stocks, surely, especially US stocks.
I'm not sure, because at the end of the day, as I said initially, the big problem that they face is that you can lower taxes, but at the end of the day, you need to reduce your spending because otherwise your budget is going to be in disequilibrium. The COB is forecasting that from the current 6.5%, the budget deficit could be by 2030 close to 9%, which is huge, which means that the confidence of international investors in the treasury bonds is going to be diminished. And this is very, very dangerous. And I'm not so sure that you need to buy US equity at any price in the current environment. By the way, I think that what we saw by the end of last week with Trump deciding that now it's postponed, but he decided, okay, by June the first, I'm going to impose 50% tariff on the European goods. I think that it's telling you that they are frightened, to my point of view. They are frightened by the fact that the Europeans are putting in place something that is new and bringing international capital into European markets. So they are perfectly aware of the danger of not mastering these fiscal deficit, the debt issue, and at the end of the day, the current account balance issue for the United States.
Well, maybe the bond market will be the arbiter of this kind of situation. You've had a target of, or an upper range, shall we say, of 4.75 on the 10-year US bond. At what point does the 10-year become attractive?
I think it's 475 and above. I think this is still the target that I have in my mind when I consider, do I want to increase the duration of my bond portfolio? For the time being, we are short to medium term maturity for quite a long period of time. We have resisted each time people were jumping into the duration trade. We said it's not over, it's dangerous. And I think that it's above 475 that it can be interesting to increase your duration. So I'm going to look around that level. What is also very interesting is that you have, over the last 10 days, more and more people speaking about the fact that you could reach the 5% level in the coming months, depending on what is going to happen with inflation. And this week, people will be very concentrated on looking at the PCE number, the Price Consumer Expenditure Index, which is going to be published by the end of the week, because this is going to be a key signal for what is going to happen with inflation in the US. People will also look at the minutes of the Fed, because this week we will have the minutes of the Fed. The Fed has been quite vocal in the course of the last 2 weeks, saying that they feel comfortable about not going too fast in lowering interest rates. They are trying to make the market believe that their expectation concerning future interest rates in the US are too high. They expect too many cuts so they are trying to refrain investors to build on that. It tells you that they do not feel necessarily very comfortable about the inflation situation in the US for the medium term.
Coming to the US dollar, euro US in particular, you had a level at 115 set that you set a couple of months ago, which we had trouble going past, in fact. Surely a lower dollar would help the US administration at the moment. An extra 5% down, that would be quite welcome, surely. Have you revised your dollar target to say 120?
Yes, we have revised the target between 118 and 120 by the end of the year or the next 12 months. I agree with you. The US administration would be very happy to see the dollar going lower. But, and this is a big but, you need to be careful. If you want to reprice or make a repricing of your currency, it can be very dangerous that you have like a free fall on the US dollar. So at the end of the day, if I agree with you, they want a lower dollar, they need to make sure that this is a process that is controlled and they do not lose control on the weakness of the US dollar. Because once again, if the dollar moves lower too fast, it will frighten investors. And what we are seeing over the last few months, which is a lot of money coming into European equities, European especially, but also bonds or assets. I think that this is something that could be frightening for the US if it goes too fast.
Coming to Japan now, and the well-reported issues they have with their long bond. What are your thoughts on this situation, and why do you think nobody seems to care except the people writing the articles about it? And why is it not having an effect on the yen?
Okay, the big problem that the yen is facing currently is that clearly the central bank has set a path that they want to increase interest rates because, and you had numbers coming last week concerning inflation in Japan. Once again, the numbers were not particularly good, but they need to be careful again not to increase interest rates too fast because it could bring the yen to a level that is going to be a problem for the Japanese economy. So they have set a path of like 2 to 3 hikes on I would say quarterly or half a year basis to bring the interest rate to control the inflation without making an appreciation of the yen super important, which would bring the activity again to a standstill. So they are in a way in a different position from Europe, which can lower interest rates. They are in a different position from the US, where we have some fears that inflation could come back and that growth could slow down. In Japan, the problem is to make sure that this inflation, quote unquote, burst that they see is a lasting one. What is very important for them is to put behind them definitively the issue of risk of deflation. That's what they are trying to do. So they are cautious. And that's the reason why the yen is not appreciating significantly because they don't move fast. They don't want to increase interest rates on a monthly basis and then see the yen going to 120 against the US dollar. It would be a nightmare for the Japanese economy.
Why does the market seemingly not mind about this quite dramatic rise in the Japanese long bond?
Because they were so low, and at the end of the day, what they it's not what is going to really impact the Japanese economy. And there is also one element that is bringing the interest rates higher, the long-term interest rates higher, is also the fact that the Japanese central bank is not purchasing as many bonds as they used to do because they feel comfortable about the fact that okay, now we can have higher long-term bonds and the economy can resist that.
One of the other comments that was a surprise last week by the US administration was the announcement of a golden dome, reportedly at a cost of $150 billion, although experts think it's possibly 3 times that much.
Yes.
My question is this really. For those who are not yet invested in US defense stocks, is it too late?
I think that it's a bit too late. And but the defense stock in the US did not necessarily perform as well as the one in Europe, where you had a significant rally in company like Rheinmetall, Leonardo, those kind of company, Thales. They performed very well in the course of the last 12 months. So it's a bit too late because you need to also see the details of what they are really going to do. It's a long-term process. It's something that you need to see in details. Does it mean that you need to jump into everything that is defense in the US? No. Do you need to try to find ideas in this area? Yes.
Francois, I think we've covered everything. Thank you very much indeed. And I look forward to speaking to you next week.
Thank you, and you have a good week. Bye-bye.
You too. Bye-bye.